Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The U.S. Trade Representative Jameson Greer says trade talks with Canada have fallen behind, while talks with Mexico have advanced. The administration in Washington preparing for this year's review of the Canada-U.S.-Mexico trade agreement. The existing CUSMA Pact runs to 2036, but leaves room for a range of negotiating formats and includes a clause that allows any country to exit with 6 months' notice. Trans Mountain planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of crude going to Asia on tankers. The Teranet National Bank Composite House Price Index fell for a third consecutive month in February. The index covers Canada's 11 largest markets. The number of houses sold in February fell for a fourth consecutive month. Now, on an annual basis, a 4.4% decline was recorded from February 2025. On the upside, some Quebec and Prairie markets moved away from the trend and posted growth last year. A deep dive for the North American markets today over fears that the conflict in Iran will continue. That's the TSX down 600 plus points right now, 1.9%. The S&P 500, 1.2% down, a 78-point drop so far on the day. The Dow Jones, 1.5% down, 724 points down. And the Nasdaq, 1.2% down right now, 273 points down so far on the day. The Bank of Canada held its policy rate steady at 2.25% today, but warned the ongoing war in Iran could push up inflation in the short term. For more on the economic outlook and takeaway for investors, we join David Wolf, portfolio manager at Fidelity Investments. Thanks for joining us today.
Hi, Marilla.
So Macklem noted, of course, that the Bank of Canada is going to walk a tightrope between rising inflation and then growth, which has really slowed down. So what, to you, does that indicate for policy options this year?
Well, so first of all, we didn't get much surprising or new out of what we saw this morning from the governor and from the Bank of Canada, in the sense that nobody expected rates to move, rates didn't move, nobody expected particular guidance in terms of what was going to come forward, and we didn't get that either. And as you say, there was a bit of, on the one hand, on the other hand, stressing about growth in the near term, as well as the implications of the Iran conflict, but at the same time suggesting that the oil prices that have gone up as a result of the conflict are going to be adding to inflationary pressure, at least in the near term. So all of it was somewhat interesting. None of it really changed either our outlook or the market's outlook with respect to where rates are going forward.
Okay, so the U.S., of course, has taken a hard line in Canada in trade. We heard the latest update today about the talks with Mexico advancing, not so much with Canada right now. What is the base case you think the bank has to take into account with regards to CUSMA?
Well, so the bank has a lot of challenges here, and one of them is not only the result that we get from the CUSMA negotiations, but also, even given an outlook for how the trade agreement is negotiated and ultimately implemented, how Canadian companies are going to react. I mean, one of the interesting phenomena we've seen is that Canadian companies got their most bearish about tariffs actually right around this time last year as they were first introduced, and right around the Liberation Day timeframe. What we've seen since is actually something of an improvement in business confidence. And what seems to have happened is the threat or the scare around tariffs to come arguably has been worse than the actual impact. Now, that's not to belittle the impact. There clearly is a weight on exports and overall activity. But it's a very challenging environment, again, one, to figure out what the outcome will be, and two, to figure out how businesses fit in terms of the impact of whatever agreement exists.
You believe that the AI trade will guide overall market direction for the year. Can you explain? And also, do you think the Bank of Canada is looking at that hard enough at this time?
So the AI trade, let me split that into a couple of pieces. So first of all, the Bank of Canada itself and the outlook, I think AI has less to do with that. I mean, it's been a support to markets, and we'll get to that in a moment. For the bank, I think going forward that the critical issue will be not so much CUSMA. I mean, again, we talked about it a little bit. We'll see where that ends up. But the persistence of these higher oil prices that we now have and the extent to which those boost growth in Canada. Because what we've seen in the past is when you get an oil price shock in one direction, that tends to be pretty unambiguous for the economy. I'll take you back 11 years ago, 2014, 2015, oil prices fell sharply with the Saudis bumping production. The economy was fine in Canada, but the Bank of Canada still cut because they saw it as a unambiguously deflationary shock. So oil prices down mean prices go down and activity in the oil sector in Canada goes down. This strikes me as something of the reverse, whereas if oil prices are sustained at high levels, inflation will go up. But also, I think when the bank ultimately runs through their models, which they didn't for this particular decision, they will see that the models will also suggest something of an uplift to growth. Higher growth, higher inflation probably means higher interest rates. So we'll see. But if the bank is going to do anything this year, my suspicion would be more inclined towards a hike in rates than a cut in rates.
Okay. You have moved away from some of your U.S. exposure. The U.S. Federal Reserve also held its lending rate, announcing that a short time ago. Why have you moved away from some of that?
Well, we've done very well in those U.S. exposures, and that's true in equities, it's true in bonds, it's true in the U.S. dollar. And the way that policy in particular has evolved in the United States over the past year plus has been troubling. And that can go in a number of different directions, but at the core of it, particularly in bonds and the currency, one of the really strong arguments for owning U.S. Treasuries, for example, is the centrality of the U.S. in the global financial system. And part of that is the reliability of the U.S., its policy, its institutions, its approach to markets, et cetera. That reliability, quite frankly, has been eroded over the past year plus with the way that policy is being conducted, and I won't go into too much detail on that. But the upshot is that the value of the U.S. dollar as a reserve currency and the value of U.S. Treasuries as the reserve asset in our minds has declined. And in that environment, we need to see better valuations to hold those assets. We, generally speaking, haven't, maybe a little bit. And that means we want to be moving money out of the United States into elsewhere. And some of that has gone into Europe, some has gone into emerging markets. But a fair bit of it over the past year or so has come back into Canada as we've gone from an underweight position in the funds that I'm responsible for, which we had for, well, about 12 years or so, to the first time since 2013, we are overweight Canadian assets in those funds.
Okay, so do you remain bullish for Canada? I know when you started the year you did, but since that, of course, we've had the conflict in Iran and then comments today from the governor for the Bank of Canada. Have you changed your outlook for Canada at all?
I mean, I think if anything, what's happened thus far in the first 3 months of the year has actually strengthened the argument for Canada, and that's particularly commodities. And so it's maybe interesting that we're leading off the close right after a show called Commodities Today, because it really is about commodities today in the sense that Canada is one of the few large, reliable producers of resources. And we seem to be in a world where geopolitical fractures are driving what I would call a scramble for resources. So that's good for Canada. It's good for the Canadian market. The TSX is comprised of, I think it's nearly 40% materials and energy stocks. That's more than quadruple the share in the rest of the world. So if commodities are doing well because demand has gone up and supply is impaired, Canada is going to tend to do well on a relative basis. The other comment I would make, so that all is true regardless of what's happening in the domestic economy, and we've seen situations, including last year, where the TSX outperforms almost everything despite a weak domestic economy. But even there, when we look at conditions right now, they're not very good, quite clearly. You talked about the housing data this morning, which reflects the fact that the Canadian housing market is in a bad place and likely to stay that way for some time. But we do think, based on our analysis, that the point of maximum pain for the economy is passing. And that reflects, for example, the passing of the maximum interest rate reset shock on mortgages. So stuff that was taken out in 2021 at very low interest rates, now reset higher. We're passing that stage. I talked about business confidence improving a little bit. So on the whole, we think the Canadian economy can tend to do better in coming quarters. And so if that's doing better and commodities are working, it's actually a pretty good environment for Canada.
David Wolf, got to leave it there, sir. But thank you for your time. I appreciate it.
Thank you.
Lululemon posted earnings yesterday. The big question hanging over that company is who's going to lead it. More in a moment. Lululemon has reported fourth quarter earnings, and they did top expectations, but the company issued weaker guidance. Let's go to Josh Shellek on this, portfolio manager at Verican Capital Management. Josh, thanks for joining us. Stock is up today, even though that guidance for sales was weak. So what are investors reacting to?
I think investors are looking at how low expectations were coming into the earnings report. So although the guidance was somewhat weak, I think the expectations were just so beat up and so low that you're seeing a positive reaction on the stock today. And there are some green shoots, if you want to call it that, from the results. You're still seeing very strong growth out of the international segments, China in particular. And I think that's what's driving the price higher today.
Okay. We talked about the fact that this is a company that still is looking for a new CEO. There have been a lot of problems for the company in the past couple of years. What would you say is the biggest weight for Lululemon right now?
Yeah, I think the biggest question mark, and maybe the million-dollar question, is whether the brand value is actually eroding or if they're just in maybe a temporary malaise and something that's going to turn around. The North American segment for the company has been quite weak over the last little while. Part of that is tariff driven. I think part of that is maybe some execution issues for the company. But again, the international segment is growing quite strongly. So the fact that you're seeing such strong revenue growth out of the international segment suggests to me that it's maybe not a branding issue. Maybe the brand is still strong enough, and that we just need to see some execution improvements in the North American segment.
Okay, let's talk about another well-known Canadian company, Couche-Tard. They also reported. I'm wondering whether you see the company now past the acquisition attempt of 7-Eleven and moving on from that.
Yeah, it seems like as you get bigger as a company, it's harder and harder to find big bites to take out there. And certainly they've kind of taken all the big bites that are out there. So it seems like they're moving on to other things, maybe refocusing on execution. They saw some pretty good profit growth this quarter, improved margins, but they're seeing some cyclicality on the revenue side as well. And I think, again, as the company grows, it's harder to continue growing. They'll probably still look for acquisitions, and it's harder to find those acquisitions out there that are really going to drive things materially higher on the revenue side. It's just based on the scale of the business.
Okay, let's talk about what's been moving the market the last few weeks, which, of course, is what's going on in Iran and the price of oil. You're not overly concerned about the conflict. Why is that?
Well, if you look at past history, and really, quite frankly, there's been conflict in the Middle East for the better part of 25 years now, and even longer than that. And markets have climbed higher through most of that. If you look at past geopolitical conflicts or wars in particular, there tends to be some disruption around the initiation of those events, but shortly after, whether it's 3, 6, 12 months, 24 months, you see markets generally get back to a stable point and march higher from there. And if you look at the last 75 years, it's very hard to find events that go from a conflict to direct negative impact, significant negative impact on financial markets. So yes, I know it's scary. It's always uncomfortable when we go through these events, and the human cost is always very real. But from a financial impact, we tend to move pretty quickly past these events to stronger markets. That's what history tells us, and that's what my expectation would be again.
Okay, so investors, of course, have been facing a year of uncertainty, starting with all of the tariff noise of last year, which came into effect as soon as Donald Trump got into office, and then conflicts since that time. What are you doing right now in the face of this latest volatility and the latest uncertainty?
Yeah, so I think investors have been facing a lifetime of uncertainty, actually. But right now, in particular, actually not a whole lot. We're kind of sitting tight right now. Despite some of the headlines, despite some of the noise that's out there, there actually hasn't been that material of a change in markets. I think from peak to trough, stock markets were down maybe 5-ish%. That's a fairly normal bout of volatility. We see that pretty much every year, usually multiple times a year. So that's not, for us, going to move us one direction or the other most of the time. So we're just sitting tight, remaining very well diversified. And I think it's very important to position right now for multiple future outcomes, despite some confidence that we'll get through this recent bout of volatility. I think there is a lot of uncertainty as to what happens next. I don't think anybody has that crystal ball to predict what's going to happen with the conflict in Iran or elsewhere. So positioning the portfolio for multiple future outcomes, I think, is extremely important here.
All right, Josh, I'm going to leave it there. Appreciate your time. Josh Shelik, Portfolio Manager, Verican Capital Management. Up next, the U.S. Federal Reserve also held its rates today. We'll get more perspective on what that means for investors moving forward. Back in a moment. Hours after the Bank of Canada held steady on rates, the U.S. Federal Reserve followed suit. For more on what it means for the U.S. economy and future rate moves by the Fed, let's go to Carl Tannenbaum, Chief Economist at Northern Trust, former Vice President at the Chicago Fed. Thanks for joining us today.
Good to be with you.
Any signals from the U.S. Fed today on potential rate cuts for the year?
No, I think the forecast from the Fed is cloudy with a chance of inflation. The conditions surrounding the war in the Middle East are obviously dominant and difficult to discern. We are experiencing some supply shocks, not just for energy, oil and natural gas, but this is going to carry through to the costs of fertilizer. It's also going to impair production in parts of the world that are dependent on Middle East energy for production processes. This, for example, could be semiconductors. So it's hard to know how wide and how deep the inflation threat will go. As most people know, the central banks tend to look through shocks like this when they assess long-term inflation. But because of the unknowns related to the war and the potential damages and duration that it could occupy, this is a very difficult decision. So for Bank of Canada, for the Fed, it's probably just as well to watch and wait.
Okay, so the Bank of Canada governor is talking about the need to balance between the risk of higher inflation because of Iran and slower growth. And I'm wondering if you're seeing the same concerns in the U.S.
Well, that, of course, is the calculus. Higher inflation is a tax on households. It impairs their spending and usually lowers economic growth. But that has to be balanced and gets the more proximate impacts of oil prices and the cost of transit and other things on inflation. Canada, interestingly, is one of the few countries where the outlook may actually be somewhat improved because of the role that oil plays in the Canadian economy. And in the United States, we are also self-sufficient in our own energy. And so we're buffered to a degree that European countries and Asian countries are not. Here in our country as well, we're seeing a lot of stimulus come through. We have big tax refunds appearing in household ledgers, as well as the ongoing boom in investment related to AI that have carried the American economy forward pretty powerfully over the last 4 quarters. So recession odds maybe have gone up a little, but not a lot. And again, with the inflation threat a little bit more proximate, that's probably what was foremost on the minds of the Fed.
One thing we did hear from the U.S. Fed chair is that There's an emphasis or an idea here that the tariff effect is weakening. Is there too much emphasis on that happening, or do you feel confident that it's weakening enough that there won't be any sort of harder hits to come? Because CUSMA, we know, is still up for renegotiations over the next few months.
Couple things to unpack there. Absolutely, it seems like the tariff effects, at least to these eyes, have been smaller and less persistent than we thought. But I've also heard from leading figures in our economy that they've been sort of waiting to see what the tariff landscape looks like with the Supreme Court decision and now the administration's corresponding decision to use other laws to try and reimpose the tariffs. It could be that some companies were holding out on increasing their prices until that was clear. But since this looks like it's going to be with us longer, there's also a school of thought that this could be lingering in goods inflation in our country for a while. Central to our trade picture, obviously, is CUSMA, or USMCA, as we call it here. That's going to be a very difficult set of conversations, given some of the issues and frictions, frankly, between the two countries. Also, this is an administration now that is a little bit distracted with other matters. And so the attention that the trade agreement between our countries deserves might take a while to build.
We also heard Jerome Powell talk today about staying on at the Fed until that DOJ investigation is over. What's the significance of that?
I think the Fed has played this beautifully. They filed a brief to try and have the investigation thrown out, and they were successful. Since the administration has named Powell's successor and would like to get on with the confirmation hearings, I sort of thought that they might quit while they were behind here. But instead, the prosecutor has vowed to refile the charges. And I think by suggesting that he will not leave until the investigation is cleaned up, that puts further pressure on the administration to, if they want to do the investigation, to do it fast, because if it lingers, their handpicked successor to Powell may be a while before he is seated.
Okay, and so how long do you think the transition would actually take? If the DOJ does move faster on the investigation or refiling in any way, how long do you think the transition would take to Mr. Warsh?
As we visit today, the Senate Banking Committee, which is the first line of defense in reviewing a nomination of that kind, has also said that it will not open that process until the investigation is closed. And so this timeline could stretch beyond the expiration of Chair Powell's term. I frankly think that once the nomination is endorsed and approved, the transition to the new Fed chair won't take very long. Mr. Warsh, of course, did work on the Board of Governors for 5 years and knows the organization very, very well. And I know that Chair Powell will be of great assistance in the transition. He's a very classy guy.
Got it. Carl Tannenbaum, good to have you, sir. Thanks for joining us today. Coming up next, the closing bells on Bay Street and Wall Street. Back a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, Summa acquisition ringing the bell. In New York, it's Hayward Holdings celebrating its 5th anniversary of listing. And for Toronto, Finance Montreal celebrating the Finance Montreal's 2026 Best Sustainability Report Award Gala. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Kind of a dismal day on the market. The TSX Composite dropping another 616 points today. That's 1.9%. The S&P down by 1.4% today. The NASDAQ about 1.5% down. Let's get to the movers in Toronto. Here's what's happening with gold. It is down today over 3%. That's a $156 drop to 4,800, about 50 there. And that meant a lot of the precious metal stocks were down. In the red, starting with Nova Gold, it dropped 11.9%, $1.58 to $11.75 for the share price. Seabridge Gold also down. It dropped 12.4%, a drop of $5.22 a share to 37 flat. And then Discovery Silver is also down close to 12%, just short of that, or $1.07 per share to $7.88. Orla Mining also moving down double digits, a 10% drop, and it is down $2.29 a share. In the green today, we do have ATS Core. It is a gainer of 4%, up $1.73, taking the share price to $43.73. Let's have a look at movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz joins us now. Bailey, Williams-Sonoma released some mixed earnings. How are investors taking it?
Yeah, mixed earnings, but the bottom line was that comp sales and for the most part margins were better than expected. We did see a strong rally through, call it the first 4 hours of trading. Obviously, when the market pulled back, as Jerome Powell spoke, Williams-Sonoma was caught in that downdraft, but really an outperformer on the day, as you can see, adding to some recent gains, still nowhere near where it was just a few months ago. But the big takeaways from analysts looking at the print and looking at management's more bullish commentary is the fact that it does seem like they're able to at least weather the tariff uncertainty in the past, and those comp sales are going to get a lot easier to meet and beat in the coming quarters ahead. It does seem like for some consumers here in the U.S., people are more than happy to continue to spend up for some pricey home goods, and that benefits Williams-Sonoma at the end of the day.
Okay, let's get to SailPoint, which is a software company also releasing earnings today. What happened?
Yeah, they were battered. Worst day since they went public. Not a long public history, but worst day as a public company on a percentage basis, closing at an all-time low. Really missing, for the most part, analyst expectations. Also, we're just dealing with so much uncertainty around software. When you look at the kind of SaaS apocalypse, what does that mean for some of these software, cybersecurity names? SailPoint falls under that. And this is a trend we've been tracking on our desk, is companies that do not have the track record of being public for a number of years are very easily dumped by investors who are looking to dial back exposure to the software ecosystem. It does seem like SailPoint, again, missing some expectations, some whisper numbers on the buy side, pairing that with a shorter track record as a public company, and you'll see faceplant like we did for those shares.
Okay, let's get to Freddie Mac and Fannie Mae, both under pressure. What happened?
Both under pressure, both down about 70% from where they were in the fall back in September. Whether you want to call that fall or late summer, I'll let you decide. But we have seen a sharp sell-off in both of these companies. The view coming into 2026 was that President Donald Trump would do something to bring these companies back public. There was talks about the tens of billions of dollars that could be raised in IPO. Now they're continuing to face challenges about what could happen with the path towards going public. We saw a number of analysts in recent days really kind of voicing their opinions and skepticism that as long as there is a war in the Middle East and President Trump and the White House are dealing with a number of things ranging from going back and forth with Fed Chair Jerome Powell to geopolitical nature, China, it does seem like the push to privatize these two companies will at least be on the back burner, according to a few analysts, until after the midterm. So a lot of hopium and bullishness that we have been tracking in recent months continuing to fizzle. And if you look at a 12-month chart of these two companies, it's pretty sharp.
Yeah, a lot of things being pushed to the back burner right now. Bloomberg's Bailey Lipschultz, thanks for the update. Appreciate it. Up next, markets dropped. Oil continued to rise as the U.S. Fed kept rates unchanged, which was expected. We're back in a moment. As the U.S. Fed held steady on rates, stocks ended lower, oil prices still climbing. Let's go to Whitney Stewart, client portfolio manager at Sterling Capital. He joins us now in studio. Thanks for coming in.
Thank you.
Okay, so that was expected, no rate change for either Canada or the U.S. That being said, where do markets go from here, and what do you think will be the biggest influence moving forward? Is it Iran?
Iran is a huge factor, and the Fed, clearly stated today that they don't know, and they're waiting and seeing. The key factor here, in our view, is will the Strait of Hormuz be open relatively soon? If that can happen relatively soon, historically, Middle East conflicts have had buying opportunities for equity investors where you get a sell-off, oil spikes, and then as the conflict resolves or begins to resolve itself, the stock market starts to go back up, and then oil tends to drift lower.
That theory, I'm wondering, whether it changes, given that Iran now saying it's going to go after infrastructure in the Gulf nations, so gas fields, refineries, and we know that a key gas field in Iran was hit by Israel and U.S. today.
Right. Yeah. So it is a TBD. We'll have to see how it resolves itself. It does appear that President Trump and the administration is attempting to rally the other countries outside of Iran to all try to push for opening the strait. And it is likely economically in everyone's best interest that does happen relatively soon, as 20% of the world's oil does flow through that strait normally. Right now, it's effectively closed. So everyone is economically motivated. However, there might be some parties who are not necessarily driven by economics here in the short term. So we'll wait and see. History as a guide would suggest that you would see the stock market sell off relatively soon off the initial fear. Then fear spikes and tops, and then the market sort of bottoms at the same time, and then eventually you get a reversal. So from a history as a guide, we would suggest those opportunities are attractive.
The TSX, of course, heavily weighted on energy. Is it on shakier ground than the S&P because of that, you think?
That is a huge differentiator. TSX is roughly 18% energy. It's almost 3% of the S&P 500, the U.S. stock market. U.S. is heavily tech. So what you're seeing is oil and energy up significantly. Tech is selling off year to date. If the Strait of Hormuz is open relatively quickly, relatively soon, you may see oil and energy have already peaked, and therefore those stocks drift lower, and you may see tech overall pick back up.
Okay, so where are you putting money today, or are you on hold in investment strategy? Because with the run-up energy has already had, and we don't know exactly when that conflict's going to wrap up, indication is it could be soon, but it's dragged on even longer than people thought initially. What are you doing as far as putting money in or holding or taking profit today?
Yeah, in our view, we think that there may be better opportunities outside of energy, I think is the best way to suggest it. And generally speaking, we think that sector is extremely highly correlated with the price of oil. So we do not believe this is going to be a multi-year consequence where the price of oil stays up 120, 125. We think it possibly may have already peaked. So we would be looking to reduce that exposure from our perspective.
You do like financials, and I'm wondering whether or not the private credit storyline is framing your outlook at all.
So within financials, it's very differentiated. So the story is private credit, and there potentially is some serious issues there. Recently, the co-head of asset management for Apollo said some of these private software companies which have been borrowing money may collect 20 to 40 cents on the dollar. In other words, may lose 80 to 60. So clearly there might be some serious damage in that area of the financials. We are looking at more of the traditional financials, companies that have great balance sheets, very strong return on equity, huge brands, very well known in the industry, very well established. These companies have a lot less risk associated with that private credit software lending, and they may be beneficiaries of AI as they're heavily investing in technology in order to reduce human labor costs, drive up revenue per human, and therefore earnings and cash flows.
Yeah, efficiency could be a big benefit to them this year. Where else are you seeing opportunity now?
We think within tech, again, it's somewhat similar to financials. The software space, we're very stock selective. There may be some unique opportunities, but there's a lot of risk there. We think some of the AI long-term beneficiaries, so for example, the data center stocks themselves are actually down pretty significantly. So Amazon, Microsoft, Google, Oracle, Meta, the one that's down the most is Oracle. That is perceived the most risk. In our view, we think long-term, Oracle's really fundamentally positioned. It's down over 50% from the high, and their backlog is accelerating, and their earnings and revenues are accelerating. Historically, those are stocks that you want to be at least looking at when those fundamentals are accelerating into the future.
Because you said you're being selective in that space, and Oracle is doing what it's doing on quite a bit of debt, which has been the concern, are there others you're looking at as well that are doing the build out and you're less worried about the money they're spending coming from somewhere else?
Yes, that's a great question. That's another big concern for the data center stocks is, are they going to get an ROI on all this CapEx? One that's just a direct beneficiary is Eaton, which is helping supply the electrical grid infrastructure, so transformers, circuit breakers. So they're not having to spend the CapEx, they're sort of getting the CapEx spending from the big five hyperscalers that's filtering through to Eaton, as these data centers take up a lot of electricity. And so their products feed right into that theme in a more conservative way, not having to take on the debt, as you said.
Okay. Interesting times. I'm sure we'll talk some more about this in the future. Thanks for coming in, Whitney Stewart, Client Portfolio Manager at Sterling Capital. Thanks for your time.
Thank you.
Coming up next, we'll break down earnings from Micron. That's coming up next. Micron Technology reporting earnings after the end of the trading day. The stock price moving up 1.25% at this point. Let's take a look at what they reported. Prices for memory chips, of course, have been soaring, and that means Micron has done pretty well. Adjusted revenue coming in at $23.86 billion. Last year, same quarter was 805, so almost 3 times the amount from last year. The estimate had been 19.74, so they blew that away. That was a Bloomberg consensus. Adjusted gross margin coming in at essentially 75%, 74.9% versus a 37.9% year over year. The estimate had been 69.1. Cloud memory revenue coming in at $7.75 billion. Data center revenue, $5.69 billion. Mobile and client revenue, $7.71 billion. Automotive and embedded revenue at $2.71 billion. Here's the forecast, which you know is key. Micron sees third quarter adjusted earnings per share at $18.75 to $19.55. The estimate had been $11.29, so well beyond. And Micron sees third quarter adjusted revenue at $32.75 billion to $34.25. The estimate way under that at $23.66 billion. So clearly a lot of things going right for Micron right now. Let's go to Kim Forrest, Chief Investment Officer, founder at Boca Capital Partners. Thanks for joining us today.
Thanks for having me.
So a lot to like for Micron there, but what's key for you?
I think that the company is raising dividends. That is a really strong indicator that they think that they can continue this performance. And even the goals for next quarter are very, very strong. And I think both of those things show the strength of their business. And we'll get more color on that, especially probably during the question and answer segment on the earnings call, which starts at 4:30.
Okay, let's talk about the fact that they are expanding capacity in Taiwan. But will the supply shortage of memory chips be long and lasting, long enough for them to sort of gain advantage from what they're doing in Taiwan?
I think so, because it takes a very long time to build these plants. This is not like, I don't know, setting up anything consumer oriented. These are extremely technical, high tech kind of facilities. And it takes a long while to set them up. Now, here's the problem. And this has been Micron's problem for forever, and it works well in this paradigm that I'm going to talk about. There are very few players that make the products that the company makes. So when one company adds capacity, it tends to push down it tends to grow the supply and then push down the pricing. And this has happened time and time again. And Micron has been a trading favorite because you could just kind of walk through those cycles, keep track of NAND and DRAM capacity in a relatively small ecosystem, and be able to make money, buy the company whenever the PE is high and sell it when it's low and just make money that way. And I think, that is kind of the conundrum here, is that, again, it's a very small space for high bandwidth memory. And that is the joy and the pain of being a Micron owner at this point.
I was going to say, doesn't it feel like the cycle itself is changing given what's going on with the AI build-out?
It does, but it's also going to draw other participants in And there are a few other players that make this product, and I would guess they're having similar results that Micron is putting up, and they too are going to expand capacity. So we are going to have another cycle, probably not so much boom bust like it used to be for DRAM and NAND memory, but it will vacillate as new plants come on and add to capacity.
Okay, because of the profound need at this time, how much pricing power does Micron really have?
Micron has a lot, but it, doesn't really want to kill the golden goose either. So I think we can see that with what it had a very nice surprise, but this isn't like an NVIDIA surprise of 2023 where it's 2 or 3 times what the street expected.
Okay, you mentioned the cyclical nature of it. Investors are looking at it today and seeing it go up and understanding why. Do they need to prepare for volatility from Micron?
I think they do. I think if you're new to this name, revisit the past and look at how this company has gone up and down and know that it's from the whole push-pull of too much capacity, the right amount of capacity, too little capacity. And the company is, a very, very good company, but you're going to either have to ride the wave or get on and off the ride, whichever, paradigm you prefer.
Which means watching it like a hawk. How does Micron keep its edge over its competitors?
Research, knowing how to make better products. And I think their high bandwidth memory product, which they came out with several years ago, actually a pretty long time, and then, it just kind of was adopted for these AI chips, kind of a happy accident. But the company is very good at understanding where its clients are going, and that would be the semiconductor makers. So I think they're an excellent company, and they should continue to do that. But the price, as much as I'd like it to do this, is not always going to go only upwards and to the right.
Yeah, definitely one you will have to watch. Kim, I'm going to leave it there. Thanks for joining us. Kim Forrest, Chief Investment Officer, founder at Boca Capital Partners. Coming up, the Bank of Canada holding the key lending rate. We'll find out what it means for the mortgage industry when we come back. The Bank of Canada maintained the key lending rate at 2.25%, despite the uncertainty and threats to inflation from the conflict in the Middle East. So how will this decision impact the mortgages of Canadians? Ron Butler, mortgage broker at Butler Mortgage, spoke to us about that.
Analysts are pricing a hike in late summer, but very unknown. Here's, one important thing is that a hike is not going to change, it's not going to end the war. It's not going to change the cost of a barrel of oil. So it's questionable in a weak economy. Those jobs numbers were terrible last month. In a weak economy, it's questionable why you'd want to hike. But the market's sort of got it priced in for end of the summer.
So the possibility is stagflation.
Correct.
And so what do the banks do with this, with their rates? Fixed rates have been sneaking up a little bit?
Fixed rates are up across the board. It started 2 weeks ago, right, really in exact coordination with the war. So we've seen about a 30 basis point hike, 5-year worse than 3-year. Used to be lots of 3-year fixed rates for 3.69. Now it's more like 3.89, 3.94. A lot of 5-year fixed is now north of 4%. So you see a lot of 4.09, 4.19 rates. Which is, bad news for the Canadian mortgage holder, particularly those who got a renewal coming up. Because let's face it, food's not getting any cheaper either.
Yeah, no, I mean, there's lots of pressures all the way around. What's driving that with the fixed?
Well, there's 2 factors. The Canadian government bond yields are up substantially, and swap rates are sort of a hedge against the future changes that banks use when they create mortgage rates. They're up as well. So we don't see any chance of them coming down in the near future. As long as oil is above $95 a barrel, we don't see fixed rates coming down.
Do you see them going higher with the bond rates? Or
Yeah, everything that goes wrong in the Middle East just pumps up the price of oil a bit and pumps up bond yields a bit. That's been a consistent. We've observed it for the last month, and it's just very consistent.
And so, if your mortgage is coming up for let's talk a little bit variables. Where are variables right now? What are they doing?
There's some good rates available on variable. Primeless 0.85, Primeless 1, Primeless 1.1. So those are rates way down in the mid threes and slightly below 3.5. So, and this is kind of a thing that we've experienced before in the past. When fixed rates started going up, variables became more attractive. Sometimes people piled into variable, but to their regret eventually. So it's really hard today to make a decision. I mean, this turbulence in the Middle East is really makes it hard to predict.
So if you've got a mortgage coming up for renewal, I mean, if you've got it over the next month or so, is it worth just holding off on a decision? Can you?
Well, the great news is if you've got a renewal that's coming up very soon, the bank already priced that renewal. So you've probably got a rate less than 4% available on a fixed rate. So by all means, grab it. If you can get a good fixed rate on a 5-year fixed or 3-year fixed, my advice would be to grab it. And those who had their renewal set a month ago, they should just call in and take the number.
And then with variables, I mean, what's the on the average a variable usually wins, does it not, long term?
Well, that was true for
depends, of course, when you lock in.
100%, but and that was very true for decades. For a number of decades, there was a long drop in bank rates and central bank rates and low inflation. That's not the same anymore. So I would have to say that flip a coin. You could be just as right on a fixed and just as right on a variable.
Awesome. All right. So what about the banks themselves? What are they doing with this today? Nothing's really going to move, is it?
No, because still 65% of all the rates in Canada are fixed rates. The Bank of Canada decision has no effect, no real effect. And the banks are just steadily thinking about how to price up fixed rates, because it's a real issue for banks. I mean, they've got rising bond yields, rising swap rates. They have to manage their portfolio, and we've seen those increases.
And I mean, I imagine they're looking at the unemployment rate that's been creeping up. We had those numbers, weak GDP. So they're looking and going, well, how do we want to keep our customers? Hey, we don't want to see them suddenly handing in mortgages like this, do they?
It's a great point. I mean, mortgage default's been creeping up. That's probably a whole different show, but it has definitely been creeping up. We're getting calls. We're talking to people in the industry. It's higher than it ever was. Now, again, mortgage default, the base rate for so many years was next to nothing. It was like 14 basis points. But you're definitely seeing an increase today, and that's having particularly in Ontario, that's having an impact on the price of homes.
And when you say creeping up, like how much is creeping up?
Well, from 12 basis points at the very lowest during COVID up to 26 basis points. And because we have a lot more alternative lending that's the bank's numbers. Yeah. Because we have a lot more alternative lending in Ontario, those numbers are much higher. They're probably in the 35 to 40 basis point range.
And when does that become extremely worrisome?
Well,
I mean, it's creeping up, always worrisome, but when does it become,
Well, the real impact of it is that when a house is sold under power sale today, that's a radically discounted price. And because comparables are set at the margins, it pulls the value of the whole neighborhood down. Like if one house is sold dramatically under what was expected, the value in the whole neighborhood drops. So we have seen this constant fall in prices in Ontario, house price in Ontario. This is a major contributor to it.
And it's showing no signs of abating?
None.
All right. And so, I mean, this puts a lot of pressure. I mean, there are people who would have bought, some of them would have bought in the last few years, and they could be underwater right now, couldn't they, with their mortgages?
Oh, we suspect that most people in 905 who bought in late 2021 and early 2022 are underwater already. And a lot of them.
And with that, so they've got their mortgages, their renewals coming up, and could we see a flood on the market with them, or no?
The great thing about the Canadian banking system is that for renewals, there's no reevaluation of the borrower situation. As long as they paid on time, they get a renewal offer, which is sort of a way to offset the fact we don't have any 25 or 30-year mortgages like they do in the U.S. But those people don't have anything to worry about. If they've paid on time, they'll receive a renewal offer, and they'll be fine.
Ron Butler is the mortgage broker at Butler Mortgage. Up next, we know the Bank of Canada held its key rate. The U.S. Fed Reserve also holding its rate. More reaction when we come back. As was widely expected, the Bank of Canada maintained the policy rate at 2.25%. We got some reaction from this and some corporate earnings from Benjamin Klein, Senior Portfolio Manager, Baskin Wealth Management.
Obviously, there's higher pressure on the bank to potentially shift rates going forward and likely raise them given inflation and particularly given energy inflation. But we did not expect any change yet, and we expect them to wait to get more data and see what they're going to do next.
And I mean, obviously, the war was the focus of this. Was there anything that stood out from his comments about the war or outside of that?
Not in terms of his comments, but the other factor, of course, is the very weak employment numbers we saw last month, and obviously that if that is a trend and that continues, there's going to be pressure on rates. Of course, we could see that be a blip, but if that's a trend, obviously that's further pressure on the bank to shift rates from here.
And where does that leave us then for the rest of the year? Do we see a rate hike by the end of the year, do you think, or is it still too much is up in the air right now?
I mean, could be. Obviously, things are so volatile, and the impacts of the war are so unpredictable, given how long it's going to last. The impacts on oil prices, what other investors and policyholders' expectations are. I think too early to say, but absolutely, there's a world in which we see rate hikes before the end of the year. I don't know. I couldn't say what that likelihood is, though.
Okay, and of course, the other one we're waiting for today is the Fed decision. It looks like it's in the same spot. So hold tight, and not much can be done right now.
Yeah, our expectation is also for the Fed to hold steady with no change. It's a relatively similar situation on their side. We think there is pressure, obviously, from the administration for lower rates, but based on what we've seen from the economics and market data, does not really support that. But we'll see.
And I know Trump has been putting a lot of pressure. He wants to see rates cut. Is there any kind of a realistic chance of that happening this year with the way things are unfolding right now?
I mean, the million-dollar question, of course, is what is the level of independence of the Fed? I think if a fully independent Fed is unlikely to do that, obviously depending on economic conditions and labor market news. But you never know. Obviously, there's competing interests at play, shall we say?
And of course, tying all this in is what's unfolding in Iran. We say it looks what may have been a stepped-up attacks. Israel reportedly targeting oil fields in Iran, also, but jointly worked by Qatar. What kind of an impact does that have if they're stepping it up and now targeting oil fields in Iran?
Well, obviously, the impact is on supply and, blockades in the Strait of Hormuz and, nothing really particular that I can add more than anybody else who's an expert in the field. Obviously, if there's, continued supply shortages, we're going to see higher prices of oil and fuel, and that's going to have flow-through impacts on businesses and shipping and air travel and everything you'd expect it to. So, obviously, I think the hope is it doesn't last for months and potentially even years, and the impacts are lesser, but who knows? I mean, it's I don't think anybody has a really fantastic idea or with a lot of precision of how this is going to shake out.
So you're just taking a kind of sit tight approach then?
We're not making any changes to our portfolio, but we're relatively low weight oil and natural gas anyway. But we're not trying to take a bet one way or the other.
All right, and a couple of companies we want to talk about and get to. Lululemon, Canadian company that has been struggling, trying to find its footing. We just saw its earnings come out, not the best. And where's your thoughts on that? What was the biggest concern with the numbers we saw from them?
So the market seems to like it, interestingly enough. It did miss on both earnings and relatively weak guidance. There's stuff to like here. Clothing is a very difficult sector. I mean, you look at Nike, for example, has been struggling for years and has not really been able to right the ship yet. There's concerns. I think this is maybe seen as a positive, is Chip Wilson's activism, the founder. I think that may be part of the reason why the stock is up today. And it's very cheap. I mean, it's trading about 12 times earnings right now. It has to prove that it's not a value trap, that the valuation is attractive, but there's potential upside here. We don't own it, but there's possibility of upside if the company can go back to growth, and which they really haven't seen over the last couple of years. And there's potential corporate action. They could look to sell the company or take it private. I don't think we're hugely likely to be investing there, but there is potential upside.
And with that search for the CEO, is that something that they should take some time to do, or is there concern that if they take time, people will be looking, going, "Oh, maybe nobody wants to head this ship"?
Yeah, I mean, always hard to balance those two things. I don't think they should. I don't think they should capitulate immediately, nor should they, spend years finding the perfect fit. I think they need somebody who's open-minded and interested in ways to potentially go back to growth and cut costs if possible at the same time. So. Don't have anybody in mind personally, but if anyone comes to mind, I'll be sure to let them know.
All right. And Alimentation Couche-Tard, they're on a roll. They're at an all-time high with their stock right now.
Yep. So we thought the earnings today are actually fairly good. The market doesn't really seem to agree with us. Not that it's been a horrible day, but not as good as we would have anticipated. It's the third straight quarter of growth, of same-store sales growth, which is very encouraging. They had very good results in the U.S., which is critically important for them. The company continues to aggressively buy back stock. We think that's very encouraging. Obviously, one concern for us is fuel volumes, what that's going to look like given the war in Iran, as we've discussed, and also progress on food sales, which is something they've been pushing, particularly at their investor day last month. So bottom line for us is we think it's a very well run business, a lot of long-term upside there, and we continue to think it's an attractive investment.
Where do you see their biggest opportunities going into, or actually not going into? I guess we're a quarter of the way through 2026. Where do you see their opportunities for the rest of the year?
We think the biggest opportunity for them continues to be the U.S. We think there's a lot more room for them to expand there, and their progress so far down there has been encouraging. And so if they're able to continue to make more acquisitions and improve the margins and improve the economics of the businesses they already have, we think that's they have a major runway for growth in the U.S.
Benjamin Klein, Senior Portfolio Manager, Baskin Wealth Management. U.S. Trade Representative Jamieson Greer says trade talks with Canada have fallen behind those with Mexico. The administration there preparing for a review of the U.S.-Mexico-Canada trade agreement. And we got more from Bloomberg's Washington correspondent, Tyler Kendall.
These comments from the USTR, Jamieson Greer, were brief, but they did send a message that isn't necessarily surprising if we think about how tensions have been escalating between this White House and Canada, particularly when it comes to trade. And as Bloomberg News reports, that President Trump has privately raised withdrawing the U.S. from USMCA altogether, though, of course, that would require a 6-month notice. The trade representative, rather, has been a little bit more cautious in his remarks, saying that there are parts of this deal that are fine and really should remain in place. Our own analysts at Bloomberg Economics have put out their projections as the trade talks are set to formally start next week, saying that there are two main paths that we could likely see. One would be an extension for another 16-year term, restarting this 6-year review cycle. But they think what is more likely is that we could see this move to an annual review cycle. Because of a few different factors here, including that the Trump administration wants to keep negotiations going and keep their own leverage when it comes to the discussion. We have to keep in mind the White House's perspective in a lot of this is that Prime Minister Mark Carney had campaigned on countering President Trump's trade agenda, and that has stirred up a lot of, I think it's fair to say, tensions between the two nations, particularly when it comes to trade. And while we do see the bulk of Canadian goods, for example, protected from USMCA, we know that there has been this frustration when it comes to some of those sector-specific tariffs, including on steel and aluminum, which still face very high rates. Now, the USTR Greer did confirm that he had met earlier this month with Canada's trade minister, who has said, quote, he's not pessimistic about the talks and that he's expecting targeting changes rather than a full renegotiation of the trade deal.
Bloomberg's Washington correspondent Tyler Kendall. Up next, we are looking at the coverage of the Middle East with Ian Bremmer. He's president and founder of the Eurasia Group. Back in a moment. The U.S. president has made it clear he'll be, quote, doing something with Cuba very soon. Nationwide blackouts have been racking the Caribbean nation for months now, the country's economy under crippling U.S. sanctions. So what could be coming next is making the Cuban community in Canada quite nervous. CTV's Genevieve Bushman has more.
At Cecilia's Cuban restaurant in Montreal, owner Alexi Diaz-Arcia's thoughts are on his family plunged in the dark. I make food here while people in Cuba have so little, he says. We keep waking up at night to see if they have power, if they're okay. Dawn has brought just a glimmer of relief to Cuba, with patches of power returning to some hospitals and homes, though not all. And the collapse has cut off running water to many, and communications are spotty.
Just waiting.
Waiting for
Waiting for what?
For a miracle.
For a miracle.
Officials warned the crumbling power network could fail again as it continues to degrade. Our food has spoiled, says 75-year-old Pedro Ramos. I'm boiling 3 pieces of chicken to try and save something to eat because the situation is really bad. This is the third island-wide blackout in 4 months as Cuba's energy and economic crises deepen. American President Donald Trump said on Monday he believed he would have the honor of taking over Cuba. And today he continued to hint at imminent developments.
And we'll be doing something with Cuba very soon.
Secretary of State Marco Rubio called for new leadership in the country. The U.S. blockade has choked off oil supplies since critical shipments from Venezuela were halted in the wake of the American attack. Cuba has announced it would open the economy, inviting those in exile to invest in businesses on the island. But Antonio Tang says he believes that's too little, too late for the government.
It is really chaotic. The Cuban government have lost totally the control of the economy.
People here continue to watch the situation closely and continue to look for ways to help the people back home. Genevieve Beauchemin, CTV News, Montreal.
Oil and natural gas prices surging today as Iran carries out an attack on a major LNG site in Qatar, following through on a threat to hit major energy infrastructure sites of its neighbors. Let's go to Ian Bremmer on this, president and founder of Eurasia Group. Ian, thanks for your time today.
Sure.
Strikes on energy infrastructure changed the timeline of a recovery here. This hit by Iran follows Israel's strike on infrastructure in Iran. So what does this do as far as hopes of a quicker recovery go?
It doesn't imply that that's where we're heading. President Trump doesn't really have a plan that's operational to open the strait to non-Iranian traffic in the foreseeable future. And absent that, they are escalating. He doesn't really have anyone to blame, and he doesn't have an off-ramp that's plausible. So that means more pain, more damage, and hopefully they find someone eventually they think they can work with. But they aren't there today. And you'll note when the Israelis hit Iran's oil capabilities outside of Tehran in the first days, the United States pushed back against that. They weren't happy. This time around, it was the Israelis that did the strikes by themselves, but they informed the Americans in advance. U.S. isn't criticizing. So, I mean, clearly the willingness of the United States to support broader strikes against Iranian energy infrastructure, knowing that it will lead to retaliation, is born from frustration and the fact that we're still not getting so much of this oil and other shipments out.
Allies, as you know, refused to get involved in policing the Strait of Hormuz, which is what Donald Trump was asking. Could that have been, do you think, an off-ramp for Trump if they had agreed to it?
It would have helped, because right now one of the carriers, and with the big fire that was on board, is having to be sent to the Mediterranean for repairs and for investigation. Also, in terms of the shipping and escorting the shipping, 3 of the literal ships that the United States had ready to participate are now going to have to go to Malaysia for repairs. That's going to be a minimum of 3 weeks, maybe much more than that. So the Americans are being delayed in their capacity to take care of this by themselves. They could use the help, even though Trump has said, as I'm sure you've seen, after the allies refused them, that he doesn't actually need their help and that the Americans can do it all by themselves. So Trump himself has been all over the map in terms of what the purpose of the war is meant to be, when the war will be over, whether or not the U.S. is engaged in a war of regime change or not, whether the allies are required. I mean, really, there's never been a foreign policy that Trump has pursued that he's been so inconsistent on in terms of his own messaging. And he's clearly unhappy about where it's going right now.
You said there's no clear off-ramp. Is there even a clear path to de-escalation?
Well, I mean, if I were advising Trump directly right now, I would tell him to stop and declare a win, which he would obviously do if he stopped, and then, work on the diplomatic engagement, not the U.S. directly, which won't be seen as credible here, but all of the other countries that really need the strait open, who aren't participating with the Americans militarily. The Indians have already had some success with the Iranian president. The Pakistanis have as well. Others could engage. That would be a path of de-escalation. But I don't see Trump taking it because for him, that feels like a loss. He doesn't think he can sell it. He's not comfortable about where it is right now because the Iranians are still able to take pot shots on Gulf infrastructure, including things like desalination plants, very dangerous in the region. They're also able to take drone shots and missile shots. And we've seen the numbers of drones and missiles launched by the Iranians over the last 10 days has been pretty consistent every single day. The drone numbers have gone up the last 3 days. So it's not as if the United States has done a lot to destroy conventional military capabilities, certainly their Navy, but that's not helping with the strait. So Trump does not feel like we're close to a de-escalation.
Okay.
Also, let's remember there are 5,000 American troops that are heading to the Gulf, and they're not on a tourist mission. They are intended to be used, and so it does feel to me like we're going to see escalation in the coming weeks.
I was going to ask you then, does this feel like the beginning as opposed to an ending?
Well, not the beginning. I mean, the supreme leader's been assassinated, right? We're well past the beginning. But I don't think we're yet turning the corner on de-escalation, on looking at an end or negotiating for a ceasefire. I think that, you've got the potential to actually occupy Karg Island. If you can't get rid of the regime, that would at least control the money that the regime would no longer be getting from selling all the oil that they are presently selling at $80 a barrel. Every day. They're sending more oil out of the straits right now, the Iranians, than they were before the Americans attacked. So something is likely to be done on that front. You've got all of this enriched uranium stockpiles that would build, if used for weapons at a higher grade of enrichment, some 10 to 12 nuclear weapons. I suspect that the U.S. and the Israelis intend at some point commando raids to destroy or remove that enriched uranium. Then you also have potentially, and this is dangerous and this would be long term, but the potential of occupying some of the southern coast of Iran to prevent the Iranians from launching all of these drones at ships going through. All of these things are presently being considered by the president. The capacity to launch those ground forces will not be in place yet until those troops are in the Gulf. And we're still about a week and a half from that.
Interesting. All right. So there could be an off-ramp there before that happens. Ian Bremmer, about to leave it there. Ian's president, founder of Eurasia Group. Thanks for your time.
Good talking to you.
All right. A quick look at how we ended the day here on Bay Street and Wall Street. North American markets deeply in the red. And the price of oil spiking today again on the recent news of that Qatari refinery being hit, the LNG refinery there. The TSX 616 points down, so 1.9% down today. The S&P, a 1.4% drop today. And the NASDAQ, a 1.5% drop. Again, that latest hit by Iran on Qatar is escalating the conflict, which means there could be a longer-term impact for oil supply now that Iran is targeting Places in the Gulf, which are infrastructure holes for Saudi Arabia or Qatar, United Arab Emirates, all of them are in its sights, and no sight of a conclusion to this conflict just yet. Thanks for joining us today on The Close. We'll see you back here again tomorrow.